Hi, this is Bruce Kaufman. I just want to introduce myself with the Mediation Divorce Group. What we're going to do is show you what we do so we can get your divorce over as quickly as possible and save you literally tens of thousands of dollars in legal fees. So this is a special program I built. It's a huge Excel file, and it's going to pinpoint exactly the income as far as spousal support, child support, asset division, so both of you can be relatively satisfied with how your divorce is going to come out. So let's start here on what we do. This is a pretty major program here. First thing we do is we have to get all your assets. Okay, home, second home. So this is an actual case. Here's a couple here that had over $1 million in net assets, just to show you what we do. For example, their primary home, it's worth $345,000. They have a $240,000 mortgage against it. So we determined they need to sell it, so we calculate the sales costs. It's with Quicken Loans. So this is important. We need to know all your assets and how these assets are titled. Now with this house, the second home, this is a home that the plaintiff, that she owned before the marriage. It's currently worth $245,000. Is it currently in a 165? So if they had to sell that, we calculate the sales costs in there. It's Bank of America. So that's titled in her name only, plaintiff. So that has net equity of $62,850. Then we go through all of their assets. They have a couple autos that are leased. The defendant, which is the husband, he has some type of classic car. It's worth $35,000, no lien. We have motorcycles. He has a motorcycles, and they have a boat that's owned jointly. He owns a motorcycle in his name. They have furniture, so we calculated, or they told me they calculated together. They have around $15,000 worth of furniture. They owe $5,000 against that from our van that's owned jointly. Stereo equipment, $5,000. Exercise, we need to get everything because it all adds up. Jewelry, specifically like the household furnishings, stereo, a lot of stereo equipment's expensive. Exercise equipment, so we want to know all of that information. Now savings accounts, for example, let's see, $25,000. Defendant has his own savings, plaintiff has her own savings account. They have a joint account. You'll see this a lot. People have numerous accounts titled in different ways. Checking account, their IRAs, we need to know that. 401ks. We have a non-brokerage IRA account with Fidelity that's owned jointly. Joint tenants with rights of survivorship, $150,000 in there. There's a life insurance, important, cash value life insurance policy. The defendant owns that. Now here's something they have. They have a business interest, a Domino's franchise. It's owned jointly, so it's worth around $225,000. Has $75,000 lien against it. So the net amount, net equity in this investment is $150,000, and they have $55,000 in credit card debt that's jointly owned. So we have to take care of that. So when you add everything up, they have total net assets of $1.3 million, or $1.13 million, or $1.130 million, $130,000. So you split that. That's what we want to look at in this scenario. The net assets divided by 2 equal division. So it's $565,000 that we have to calculate for each spouse. So now we have to look at the equalization of the net assets. So the plaintiff, which is mom, she had $515,000 of assets in her name with liabilities of $182,000. And this is where a lot of mediators get this wrong. So her net amount, her net assets that she owns in her name is $332,000. The defendant has $435,000 of assets, so he has less assets, but he has no liabilities, so $435,000 in his name. They have joint tenants with rights of survivorship. There's 2 types of joint tenant holdings, and this one is for their house and a brokerage account, so $495,000. $264,000 liabilities, so it's $230,000 of net assets in that account. For just joint, $303,000. $116,000 liabilities, so it's $187,000. They don't have any money in a family trust, and they have $55,000 in that credit card debt. So they have 1.7 million of total assets, 617,000 liabilities. So that $1,130,700 net assets. Equal share is 565. So the plaintiff needs 232,500 in assets, and the defendant needs an additional 130,350. So we break this down even more. So the plaintiff needs 232. So she's going to get the $150,000 in that brokerage account. We already went through this. That was the, let's see, this count right here with Fidelity. So she gets that in her name. Then she's going to get 10,000 in checking accounts. She's going to get the net equity of the home, 80,850. No additional cash. So that's 240. So that's too much. She only needed 232, and she's getting 240,000. So plaintiff needs to come up with an additional 8350. So here's what she's going to do. Out of that one checking account she's going to get in her name, that's where she's going to come up with that 8350. So she'll net 1650 out of that. We need that money to pay off that credit card debt. We don't want to have any credit card debt at the termination of the divorce. She'll keep the primary home net equity, so she'll be in pretty good shape. Okay, let's look at the defendant. He needs 130,350. He's going to keep the Domino's Pizza franchise. Net asset value, that's 150. Exercise equipment, stereo equipment. He's going to take the boat and a motorcycle, so that's 182,000. So he needs to come up with an additional 51,650. So what we did here, he's going to sell the boat, motorcycle, and that money's going to go pay off his share of the credit card debt, and he's still 26,650 he has to come up with. So what he's going to have to do, so we look at this chart right here, and the defendant, he's got 25,000 in the savings account, so you can wipe that out. Then he's got some additional money here. He needs to come up with another $1,600. Okay, so here's that 25,000 in that savings account he has in his name. So he's going to take that and an additional $1,650 and use that to pay off that credit card debt. Okay, so now we're going to talk about income and the budget, pre-divorce and post-divorce budget. All right, so let's dig into this. Okay, so mom is 42, plaintiff's 42, defendant's 45. So in the pre-divorce, we had to get their income. Okay, I'm going to use instead of plaintiff and defendant, mom and dad. So mom, she makes $5,600 a month. Dad here makes $8,480. They have that miscellaneous income from the pizza business, so it's $3,000 a month. So their total income is $17,080 a month. We're going to go over their expenses a little bit. So they're in their life right now, pre-divorce, they actually have a monthly surplus of $661 a month. See, we're right to the penny on this. It's very important in these mediation meetings to do it in divorce settlement to get the exact amounts. That way everyone will be taken care of properly and they'll be able to get on with their life. Okay, so that's pre-divorce. So now let's look at we're going to come back to this a little bit, how we calculated their spousal and child support. Let's look at their expenses. Okay, their housing expense or their home expense. We have the current mortgage is $2,000 a month, property tax $600, condo, lawn, care, so we need all this. It's really important. General maintenance costs, house cleaning, pool maintenance. They have a pool, all their $100. So their current household expenses just for their home is $3,275. Now they're going to have to sell. They're going to sell the house, and they're each going to buy their own individual house. So what we did here, we made a baseline. So what we did, let's take a look at this. We have a mortgage worksheet here. We had that baseline as far as that each individual is going to get the same house price. All right, whether they want to buy a more expensive house after the fact or less expensive, it's up to them. But for mediation purposes and for the budget now, this is what we did. It's really interesting. So we made a baseline of $250,000 new home price for plaintiff and the defendant for each one. So they're each going to go out and buy a house for $250,000. Then we had here for their down payment. So we even calculated their monthly payments here. So on the down payment, they're each going to put down $20,000 from the marital assets. We calculate 4% interest rate, 30-year mortgage. Loan balance at $230,000. Monthly payments $1,098. Mortgage insurance is $153 a month because we're going to be at a 92% loan to value ratio. We wanted to keep as much cash as possible. We want to put down the lowest down payment possible, so we calculated that. So we do this for you. Now, property tax millage. It's really important because each city that you move into has their own property tax rate. It's called a millage, so we need to know that. So mom's moved into a city that has a $42 per thousand millage. Dad wants this one city $55. Okay, so we'll adjust for that. So property tax is going to be lower for mom, higher for dad. Closing costs, when you buy a house, you have to have closing costs as far as getting the mortgage and prepayment of taxes and insurance, all that type of thing. So it's around 5% of your total loan balance. So it comes out to $11,500 for each one. So total cash to close. So each one's going to need $31,500 to purchase their house. So that's what we budgeted into for this situation. So now let's look at this. This is their home on the post-divorce basis. Post-divorce. So their rent or mortgage is going to be $1,251 a piece. Property tax filters over. Mom's getting the condo. Dad's going to buy a house, so he's going to have the association fee still for the common grounds, but the condo association fees take care of more things. They take care of the outside of the house, so if you're familiar with condos. So she doesn't have to pay for lawn care. She doesn't have to worry about that. General maintenance. Dad's moving the house, so he's going to cut his own yard and remove his own snow. No house cleaning. So we're going to get rid of the house cleaning because we're in divorce now. So we're going to have to really manage our money more efficiently. No pool. Mom's going to have a pool within the condo. So they're let's see here. So mom's going to have a monthly house payment of $1,988. Dad's going to be at $1,874. So now, because you have two separate households, your total monthly cost in this scenario is $588 a month more than just owning one house. Now we're going to talk about taxes. All right, so let's talk about taxes. So in our pre-divorce over here, we're filing as a married couple, so our effective federal tax rate is 18% because we have a higher combined income. So in this scenario, we have mom's paying a total of $1,760 in taxes. We did it based on her income and on his income. So together, they're paying quite a bit. Looks like around $4,500 a month in taxes. So when we look at their tax rates when they're divorced, so now you're going from a joint filing status to a head of household status. But the thing is, now each of them get their own exemption amount. So when we do the calculations their taxes actually go down when you're divorced, the way it works out, because you're splitting the you're splitting your incomes, but you're also each taking your own exemption. So that's a good thing, I guess. When you get divorced, your income tax rate will go down. So that's $537 a month. That's pretty substantial. All right, let's take a look at medical insurance premiums, $1,195 a month. So we want to take all of your different medical expenses, and there's a lot here. Insurance premiums, co-payments, prescription drugs, optometrist glasses, physical therapy, orthodontics, dentistry, mental health care. And going through a divorce, you got kids. It's important to see a psychologist or a social worker or somebody to talk about all these, stress that you're going to be under. There's different types of policies. Cancer policy, I have one of those. Disability policy, if you become disabled, get a monthly income from the insurance company. Life insurance, pet insurance is important. I have pet insurance. I had a dog that was in the hospital for 5 days. It was $2,000, but luckily I had a pet insurance policy on him. So your insurance is $1,200 a month. So when we break that up, now we have to have, on post-divorce, each person has to have their own insurance policy, deductibles, and co-payments. So when we do the math, that's an extra $645 a month right there. So your insurance goes up. Child care. Okay, so we look at tuition payments, school lunches. School trips, camps, all that kind of stuff, 270. So that's going to stay the same. Food's going to go up a little bit, 500. Well, it's going to go up quite a bit, $500 a month, because now you have two households to take care of, and the kids eat a lot. We're going to look at our clothing, personal care. We're at $1,100 a month. Pre-divorce, we're going to have to really tighten the budget there. So we went $500 a month in clothing to $100 a month for each family. We have to stay on this budget, so we're going to try to save $590 a month on our clothing and personal care. Gym membership we're going to get rid of. Haircuts you still have to have. Dry cleaning you have to have. Club dues, we're going to get rid of some clubs. This is just for the intermediate until you get your get your sea legs back. Makeup, $65 a month, but we're not going to put that in the budget because Dad shouldn't. We decided that Dad, shouldn't have to pay for that. Mom agreed with it, so we took makeup out of the budget, and we took the nail salon out of the budget, so we're able to save $590 a month there. Okay. Pet care, if you have a pet, pet's expensive, $105 a month. Add up everything: pee pads, toys, pet food, right? License fees, vet fees, all that good stuff. So that's going to be the same. What else we have? We have entertainment, movies, concerts, so we're going to knock that out. Save $300 a month there. We have vacations. Okay, so went on vacations, winter vacation, spring, $2,000. This is annual, $5,000 annual for winter, $2,000 for spring, $7,000 for summer. Went away for fall, some weekend getaway, so it's $1,333 a month. So through some, give and take, negotiation, mediation, we're going to allocate $1,000 a year towards a winter, probably getaway, weekend getaway, $2,000 for summer vacation, no fall vacations, and allocated $500 for each family for a weekend getaway. So we're able to save $750 a month there. And our retirement plan contributions, they were making $2,600 a month in retirement plan contributions. This is on an annual basis. Each one was doing $4,000 into their IRA, $12,000 into their 401ks. So what we did here through our mediation process, we determined that we're going to allocate $5,000 towards Mom's 403b plan. Dad's not going to do anything right now, but he agreed to put $5,000 a month or $5,000 a year towards Mom's 403b plan, which is very important. So that's going to save $2,250 because we're knocking out most of the retirement plan contributions for now. Okay, so that's all our expenses. Okay, so now we're going to look at the spousal and child support calculation. So it's going to be the good part of it. All right, so let's take a look at post-divorce. Here's Mom, her income. So as you can see here, she's got a total income of $5,600 a month. Total expenses of $7,412. She's $1,800 a month in the hole. Dad's got his regular income, $8,480. He's got the pizza joint. That's pulling out $3,000 a month there. So he's got $11,480 in total income, $8,500 expenses, and he's got $3,000 a month in surplus. So this isn't fair. Dad agrees that Mom shouldn't be in the hole, $1,800 a month, and Mom's pretty upset that Dad's coming out with an extra $3,000 a month. So how do we fix this? Okay, that's what we're going to take a look at right now. Okay, so now we're going to look at our support. So here's our child support. We have our 12, 8, and 5-year-old. So the formula, there's a formula for each state. So that's going to show $1,600 a month. So it's $533 each. So what we do there is on the 12-year-old, 6 more years there. So it's total child support of $38,400. 8-year-old 10, $64,000. 5-year-old 13 years of support, $383,000. So Dad, total child support obligation for Dad, the defendant's $185,600. So he'll be $58,000 when he's done with his child support. So that's going to filter right up here into Mom's income piece, $1,600. So when we add the child support, Mom's $212 a month in the hole, and Dad has a $1,367 a month surplus, which still isn't fair. So this is where we're going to figure out her spousal support, and this is how we do that. We'll start off with, let's say, $1,000. So $1,000 a month, that gives mom $787.36 surplus, and dad $367.51. So we went back and forth. We decided, is that fair, this and that. So we just changed some numbers around. So we came up with this $800 a month number. So it's going to give mom $587.36 monthly surplus, and dad $567.51 monthly surplus. So we did all the budget, we figured out what the deficit is for each spouse and the surplus, and we negotiated this spousal support arrangement of $800 a month. Now I also calculate the future value of each one's retirement plan at 7%. So the plaintiff mom, her situation when she's 52, she'll have $500,000 in her retirement plan at $57,800, and when she's 67 at Social Security age, she'll have 1.6. So I try to balance this out also. So dad's going to have 1.6 million at age 70 in this retirement plan. So they were happy with that. They're able to have a secure retirement. They're going to have some monthly surplus every month that they should put away. Okay. Let's see. We also talk about college. Here's a big deal. Because I see a lot of plans where they want the parents to put money away for college. Well, if you're really rich, you can do it. That's great. But in this situation, let's look at this. So there's a couple with almost $2 million in assets, cost of college, state college, room board tuition, other $29,000 a year. You got 3 kids. Inflation rate, college goes up at around 7% a year, right? So the future cost of college, child number 1, okay, that's 6. That's going to be $65,000 a year in his first year. So that's going to be $289 for a 4-year college degree for the 6-year-old, for the 10-year-old $221, and for the 13-year-old $180. So that's $691,000. So it's impossible to save for college, just impossible. So we talk about this a little bit further. If you're in a certain financial situation, you really, you're going to do what you want, but I recommend, as a financial consultant mediator, really, look at the benefits of a community college for the first 2 years. Okay, the total cost, $6,000 right now, probably a year. That's probably even high. Okay, so let's say $6,000 a year for community college, first 2 years. Then your second 2 years, your junior and senior years, $29,000 a year. So that child 1, he's going to go. All the kids are going to go to community college year 1 and year 2. Then they'll transfer to the university. But look at this. Just by doing that, you just saved 44% on your future college costs. Okay, so a total cost of $389. So the kids can work, or the parents are able to help out in the first 2 years, possibly, with the kids' community college. Then in years 3 and 4, if the kid has to take out a student loan, okay, of $65,000 and $70,000, $130,000, if they work, it's more affordable. College is very expensive, so to expect, a parent to, pay for that in full, that's unrealistic. So we want to look at that. Let's see what else we have here. We show the plaintiff, the person receiving the child support, what's going to happen when their support reduces. Let's say in this case, the first kid comes off in 7 years when she's 49 years old, so she'll still have a monthly surplus, so she's not going to take a hit on her monthly surplus. When the second child comes off in 11 years, so she's going to lose a total of $1,066 when she's 53. That's a monthly deficit of $479 or $57.51 a year. But if she took that monthly surplus that we provided for her right now and just put that in the savings account, she'll have $111,000 extra there that will more than make up for that annual deficit. Or if she chose to work at 20 hours a week, she would have to work an extra 6 hours a week to cover that $1,000 reduction in income. Then year 14, when the last child comes off, she loses all that child support. That's going to be a $12,000 annual deficit. But if she took that surplus, that we generated during the mediation and just put that away for 14 years, she'll have $158,000 in a savings account that will, make up for that $12,000 a year loss. Okay, so that's our mediation report, and really worked out good in this scenario, and we're able to do the whole process, because I have to get all your information, tax returns, bank statements. I have to verify everything before I put together a report. So in 20 hours, okay, we can get this done for you total, with our meeting, going back and forth. Most of the time is going through all your documents, verifying everything, and we can really help you tremendously put together a plan, a mediation plan that's going to benefit both of you and save you literally, months, a year, tens of thousands of dollars in legal fee. Okay, I want to thank you. My name is Bruce Kaufman. I'm a mediation consultant. Here's my phone number, my email address, and look forward to talking to you soon. If you need help with your divorce and you want to get it over with as quickly as possible. All right, thank you very much. Have a good day. Bye-bye.